Good morning, everyone, and welcome to our webinar today. We're excited to have our very own John Grant and Jenny Hollingsworth presenting on production order costs and your general ledger, what you need to know. And I know you're all eager to get started with the presentation. So before I pass it over to John and Jenny, as a reminder, we are recording this webinar and it will be posted to our on-demand webinar library for you to review again or share with anyone. And if you do have any questions during our presentation, please feel free to raise your hand or type them into the questions box, and we will get them answered along the way during the session. So now I'm going to pass it on over to Jenny to kick off our presentation.
Thanks, Angie. Good morning, everyone. My name is Jenny Hollingsworth. I'm a senior application consultant here at Inovia Consulting. A little background on myself in case you don't know me. I've been working with Inovia Consulting for, this year will be going on 16 years. Prior to that, I worked for another NAV partner for about 10 years. So all in all, about 26 years working with NAV and Business Central. And I'll let maybe, John, why don't you give a little bit of background on yourself?
Yeah, welcome everybody. My name is John Grant, also Inovia, obviously. Senior application consultant. I've been with the company for 12, 13 years, I think. Previous life have worked on several different ERP products, including the old AX, which is rebranded, Sightline Made to Manage, M1, and a few others. And my passion has always been, I'm a lean enthusiast with always kind of focused on manufacturing and, you know, the cost side of it and planning and all those, all the fun stuff, not so much the debits and credits, but you know, that it's all part of the puzzle. And hopefully we will confirm what you know already, or maybe there's a couple areas that help you understand it a little better. So.
All right. Thanks, John. So like Angie mentioned, we're going to talk about production order costs and how they affect your general ledger. So we're going to look at all of the different cost components of a production order and what they are, what each production transaction is and how it posts to the general ledger, and a little bit on the setups of that. And then we'll finish by talking about finishing a production order. We're going to talk a bit about what's the difference between standard costs versus all other costing methods when you finish a production order. So let's first look at the cost components that are on a production order. We have a few different ones. Raw material costs, of course, so your consumption entries. Then we add in your labor, and that could be direct labor, and then also overhead costs. If any of you work with subcontracting and using NAV or Business Central subcontracting worksheet, you can add in subcontractor costs. And then finally, manufacturing overhead, which is a nice feature to use. And I think that's probably, out of all the costs, John, I don't know if you agree, is probably the one people don't know much about.
Yeah, I think everybody's familiar with material costs and the labor. Maybe a little bit separating. Okay, I've got machine overhead versus, you know, labor overhead. How would I do that? Subcontractor, yes, but the manufacturing overhead is there, and we'll talk to that a little bit.
And then all of these cost components, of course, roll up and equal your total production order cost. So maybe, John, maybe you could talk about this production order statistics screen a little bit.
Yeah, let's talk about, okay, on any production order, I think everybody's probably familiar with when you create a production order, whether it's, I don't know, firm plan or release. Let's focus on those two types. When you look at the production order header, there's statistics, and on there are 3 columns. Standard cost, if you're running standard costs, those would be populated, and it breaks it apart into the material capacity, subcontractor capacity overhead, manufacturing overhead to come up with a total at standard. And the expected cost is right now, based on when I create a production order. Let's pick on material. Let's say we're not a standard coster. It would be let's say we're a FIFO costing. Any of those, it would use the unit cost as expected cost. So it's not the actual layer yet. If you're familiar with BC/NAV, keeps track of if I buy something last week, it's got a layer for what I paid for it. If I buy it again this week, it's got another layer. And there's a unit cost on the item record, which is an average of both layers. So that's what it used for expected. And actuals, as you post labor, material, subcontractor costs, those will go into the actual. So in the end, you have an expected versus actual. Now, hidden in here, if we got the any cost detail people on the call, the one of the things that is kind of hidden is I have a routing typically of here's how I expect to run it, right? So I've got machine rates, machine overhead. When I change, I as a planner, I'm focused on the due date. I need to update that where I'm going to run it. I'm not going to run on line 1. I'm going to run it on line 2 as an example. That might be a slower line, or I'm going to run it on a 100-pound press or a 100-ton press instead of a 50-ton because I don't have capacity and I normally run it on a 50-ton. The production order reflects how you run it for the expected cost, and then your actual gets accumulated. So just be aware that how you might have developed your cost, if the planner, and that's what their job is to get it done by the due date, they might run it not like you built your costs on. So that's something to consider when you're analyzing how did we do. But this is the scorecard. So when I have a finished production order, I can look at, well, here's my expected cost when I created it. Here's our actual costs. How do we do? And this is also a good screen when like in your production orders, when I'm done with it, someone has to go in and finish the production order. And this is a great scorecard to look at to go, hey, we don't have any material cost yet. We got 0. Something's not right. I don't want to finish my production order yet because we're missing my material costs. If I were to look at this, hey, what's up? I don't have any material costs. I've got labor, subcontractor, a little bit of manufacturing, but where's my material? Red flag goes up. So who's ever finishing the production order, this is a good place to look at to understand, yeah, that looks reasonable. I can finish it. Or in this case, I don't have any material cost. I better find out what's going on here. Because if I finish it, I will be missing my material costs. So good scorecard place.
Yeah, and apparently this ran well over $12.11 to $450. And one thing to note too is that variance column is a variance between standard and actual. So if you're not using standard costing, that variance column really won't mean much to you here. Okay, so why don't we begin and look at the different production transactions. So first, let's talk about consumptions. And what we'll do is talk a little bit about it, and then I'm going to flip into Business Central, and then we're going to post some consumption and see how that hits the general ledger. So 2 different journals you can post consumption of raw materials from. You can do it from the consumption journal or the production journal right off the production order. When you post that consumption, it immediately creates an item ledger entry to remove the raw material from inventory. And one thing to note is the unit cost it uses is based on the item's costing method. So if you're FIFO costing, it's going to go apply to a purchase or positive adjustment based on FIFO. And it's going to use that actual cost to then post as cost to this production order. If you're using standard, of course, it'll just use the standard cost. It will also post a general ledger entry. And if you have inventory set up, automatic cost posting selected, it'll do that right away. If you do not, it'll do it next time you run your adjust cost item entries. So that general ledger entry, it uses GL accounts from your inventory posting group on your raw material. So it's going to debit the WIP account from that inventory posting group and then credit your inventory account. So why don't we flip over to Business Central, and I just want to make sure, John, do you see the Roll Center?
Yeah, I do. Yep.
Okay. All right. All right. So let's go look at a released production order. All right. So our released production order has expected components and routing. If we look at that statistic screen John mentioned, you can see here is our expected cost. I'm not working in a standard cost environment. I'm working in a FIFO environment, so our standards are 0. And then, of course, we've posted no actuals yet, so that would be 0. All right, let's go ahead and do post some consumption. So I'm going to go ahead and I'm going to do it from the production journal. All right, I'll expand the screen. All right, I'm going to go ahead and just filter on consumption entries. And go ahead and post consumption. Maybe in this instance, I had to use a little bit more sugar. Maybe I spilled some on the floor. Who knows what I did? So I can go ahead and change any of the consumption quantities. What it did is it brought in my expected consumption. And I'll go ahead and post the transaction. All right. So if I close that production journal, if we go back and look at the released production order, if you look at the order statistics, all right, you can see here that our expected cost was $227.09. Our actual cost was $227.45. Added a little extra sugar, so the cost went up. So from the production order, if we go to related, we'll go to the order entries and look at item ledger entries produced. Here we can find all of our consumption entries of our raw materials, how much was consumed. And then here in the cost amount actual, you can see the actual costs of that raw material consumption. So this column will total up to that I think 227 that was under the actual costs on the statistics screen. All right. So if we go ahead and look at the general ledger entries produced so far, I'm in my chart of accounts looking at my general ledger entries, looking at all GL accounts. I'm just going to filter on that production order number 1005. Okay, so since I'm in the GL entry screen, I have no GL account filter, and I'm filtering only on my production order number. Here I can see all of my transactions posted so far, which is just consumption. So here you can see it posted a debit to 10750 WIP, and then a credit to inventory. All right, and again, these GL accounts are based on the inventory posting group assigned to the raw material. All right, any questions or comments on consumption?
Yeah, the cost it's using is what? You know, to calculate for this material, the initial during the process, it should be using the unit cost for that item, which is because it doesn't know what layer to issue yet if you're running FIFO. Correct? That's what it's doing, Jenny?
Do
you agree with that?
Correct. The unit cost from the raw material card?
Yeah, because when you think about it, it's just saying, oh, this is the that will get adjusted correctly when that item adjust cost runs. That's one reason to run that item adjust cost. If it's, that's what that does. It backs out what I'll call it the expected cost was, which is the unit cost, and replaces it with the layer cost that was used, FIFO. If we're running FIFO, the oldest layer, just to clarify that material.
I guess, yeah, that's correct. You didn't see this in our instance because we have automatic cost posting selected. So you never saw the cost amount in the expected column.
Right.
Any questions on consumption entries?
And the takeaway is to me is what cost is he using and how's it work? And that's pretty straightforward for material.
All right, so let's talk about labor and capacity. So labor is posted from the output journal or the production journal. And instead of an item ledger entry, this creates a capacity ledger entry. Now, the costs on a capacity ledger entry are going to come from your work center or your machine center for the operation. On that work center or machine center card, there's a direct unit cost, which will be your direct cost applied. And there's also an indirect cost percent and an overhead rate. If either of those are populated, it'll use the overhead applied account. As you know, once you post that output or production journal for labor, it will, and of course, if you're automatic cost posting or you run your adjust costs, it'll debit your WIP. It'll credit direct cost applied and credit overhead applied. Now the GL accounts for direct cost applied and overhead applied come from your work center or machine center, whatever general product posting group is set up on there. The debit goes to WIP, and that will be on your finished good inventory posting group. All right.
I have one comment on that, on this work center machine. We're seeing more and more customers have an operation that represents the, let's say, the machine. So they developed an overhead for that machine, but then they break out the labor into what's called a parallel routing step. So they might have a setup person with different, direct and overhead rates, and then they have maybe a packer or a couple people running the machine. We're seeing that more and more where that type of level of detail is needed, and you can do that. It's just how you set it up. So think of it as I've got a operation step for the machine running, and I've got rates for that. But then I have a parallel step for the number of people, because they're, we got different overhead. Your overhead for a person might include benefits and whatnot, where a machine, it might be the, the utilities and floor space it occupies and all those kind of different things to develop the overhead. So just to add that to the puzzle as you want to get more and more, if you need to get more and more precise on your how you apply the overhead and direct labor.
All right, so let's look at our released production order once again, and we're going to post some labor entries. So we're going to do this from the production journal. All right, so here we see all of our operation steps. I'm going to go ahead and post some setup time. And some runtime. All right, but I am not going to post output yet. So I'm going to go ahead and change my last operation step to 0 for output. We're doing all of the packaging, manufacturing and packaging of our M&Ms, and we're to the point where we're going to send it out to its subcontracting for taste testing before we would actually put that in the inventory. So we're going to go ahead and just post the initial labor. All right. So now if we go look at our capacity ledger entries, here you can see all of our operation steps, the amount of time we posted, and here you see the direct unit cost and the overhead cost for each operation step. In this specific production order, Work Center 140 does have an overhead cost associated. It looks like the other work centers just have a regular direct cost. John, should we show the work center card and show those fields?
Yeah, I think so. Yeah, I think that, where do these costs come from? That's a good.
All right, so here you can see on the packaging work center, we have a direct unit cost of $15 an hour. And then we have an indirect cost percent of 10%. So our total unit cost is $16.50 an hour, but you'll see it split between direct and overhead.
Yeah, and some customers think of that indirect cost percentage as the benefits for that average hourly rate in that department, if you think of it that way. How to develop basically you're developing a cost per hour, which is $16.50.
And John, have you seen people with working with machine centers or work centers where maybe for one specific operation they have one machine center for like person labor and one for machine costs?
Yeah, it depending, and in each company, I feel is different. But like I mentioned, I see more and more companies trying to, I guess, get this absorption and all. The cost that typically is a GL entry at month end, they want to apply it as they go, right? They don't want to get to the month end and then. So even this labor that we did manually, some people are automating that. You can automate that if your routing you feel is solid. If I made 100, hey, let's quote unquote back flush the amount of labor it takes to make 100 pieces. That can be done. But yes, they might have multiple. One operation might be for the machine, and then a parallel one for a setup person I only need for a half hour or 1 hour out of the 8-hour run. And then I need 2 people to run the machine so I can absorb labor for 2 people, either reported manually or automatically, to help with that month end. The puzzle is always, what's my absorption? I'm trying to absorb as much as I can into the production orders, and that's just part of the puzzle of how you want to set it up. So BC does support pretty decent job of doing that kind of, I'll call them advanced costing if you needed that. One benefit of that, of course, is if you do set up people, I as a planner, I know in today's environment, I might have more machinery than people, and I want to know how many hours I've got available. That would help with that. I'm not only scheduling the machine to run, but also the people, so I can take a quick look at tomorrow. I've got 200 hours of people time, and where am I going to put them? Because I've got more capacity than that on the floor. So that also helps with that puzzle, trying to figure out where to put people or yeah. So anyway, it's available.
All right, so let's go ahead and look at the GL transactions that the capacity ledger entries produced. If we go ahead and go back to the GL entries, I'm just going to refresh my screen. And refilter on my production order number. All right, so you can see here indirect and direct costs. The indirect cost posted is the overhead applied. Okay, so if you remember, we had a direct cost column in the capacity ledger and an overhead column. These GL accounts, again, will come from the general product posting group attached to the work center or machine center. There's a direct cost applied column and an overhead applied column. So we got some posting to overhead, and then the rest posting to direct cost applied, and of course the balancing entry is then WIP. Now you'll see a lot of entries here, and one thing I want to note is it posts in detail to the general ledger. It doesn't summarize. So for each capacity ledger or each item ledger, it's going to post a debit and a credit to the general ledger. And of course, on the capacity, if you have a direct labor and an overhead, it's actually posting 4 entries. You know, 1 to overhead and WIP and 1 to direct cost and WIP. So it does end up creating quite a few GL entries. All right. Any labor questions at all? We'll have a question answer at the end as well, but we just want to ask while we're going through it.
One more thing on the statistics. Before I finish this production order, we often, you know, you can catch, oh, we recorded too much labor. Let's say we had, I don't know, let's say our capacity cost was, well, this one here, it's like, you know, almost what, 10 times what I thought it was going to be. I might investigate that. Oh, somebody fat fingered entering time. You know, they put, you know, let's say 1.5 hours and it should have been 15 minutes. Before you finish a production order, this is a great statistics screen, is great to just give you a, I don't know, it's kind of a overall, does it look reasonable? And this one I might say, you know, we've got too much in capacity costs, what happened? And maybe there was rework, maybe there was a reason, but then, okay, that's fine, then I can finish the production order. But again, somebody is eyeballing this screen before you finish it, because once you finish it, you can't come back and make corrections on a production order. In other words, if we were to finish this and then we go, wait a minute, we charged 10 hours instead of 1 hour, I can't go back, reopen this order and change it, you know, reverse out 9 hours. So very important to use this screen to help when you're finishing production orders to catch some, I'll call it obvious errors possibly.
Right, so at this point you could reverse time if necessary by doing a negative entry in the output or the production.
And material also, yeah, you could do, yeah, absolutely.
All right, so what's next? Let's talk about subcontracting. I know, working with a lot of customers, not a lot of people use the subcontracting as is in NAV or BC, but we wanted to show with base NAV or BC subcontracting how it works. When you use subcontracting, you're gonna calculate subcontracts in the subcontracting worksheet, which will then create your purchase order. And when you invoice that purchase order, it will create a capacity ledger entry for that subcontracting time. And again, when it creates that capacity ledger, if you have automatic cost posting, it'll make the GL entry. Otherwise, it will when you run adjust cost item entries. So what happens here is on your worker machine center, again, you have a general product posting group associated. And on that product posting group, there's a direct cost applied account. So in this instance, you would set that direct cost applied account to where you would like your subcontracting costs to post. And then the debit, of course, is a WIP account from the finished good item posting group. All right, so let's take a look at subcontracting posting and how that works. All right, so I'm on my release production order. I'm going to go ahead and open the subcontracting worksheet. And let's go ahead and process a line for this production order. All right, you can see it brings in the taste testing. I have 50 packages. And I did not populate a direct unit cost, so I'm going to go ahead and say it's going to be $1 a package for taste testing, and go ahead and carry out my action message to create my purchase order. All right. So if we look at the capacity ledger entries, we'll see, or the statistics screen, I can see there's no taste testing in here yet. Again, it does not post until we post our invoice. So let's go ahead and post that purchase order as invoiced. Put our vendor invoice number in. It's still 50 at $1. That looks good. Let's go ahead and receive an invoice. All right, so back on our release production order, if we look at our order statistics, you'll now see we have an actual cost of $50 for subcontracting. If we look at our capacity ledger, you'll now see the top line here, taste testing, direct unit cost of $50. And if I look at the value entries on this transaction, I'm just going to use this to get to my general ledger entries. You can see it posted a negative 50 to 5,400, which is my direct cost applied subcontracting. And then it added a debit of $50 to WIP. So again, this transaction occurs on posting of the purchase invoice. Anything you want to add on subcontracting, John?
It works well. I think a lot of it is just to, if you aren't using it, to mock it up in a test company and understand how you might be able to use it. Yeah, I mean, it's not complicated, so it's an easy one to mock up and test to see if you could make use out of it.
All right, so our final cost component is one that I don't see used too often, but it definitely has its place for how it can be used. It's manufacturing overhead. One thing to note with manufacturing overhead, it shows on your production order statistics at time of your output transaction, but the costs don't post to the general ledger until you finish the production order. So that's an interesting little tidbit. When you post your output for your finished good, it gets the cost for the manufacturing overhead from your finished good item card. On your finished good item card, there's an indirect cost percent and an overhead rate field that can be used, and that's where it gets those costs from. And when it posts, it'll debit the finished good inventory, and it will credit overhead applied. And that's both based on the finished good item record.
So
So
let me add a couple notes on that before we show you. What's an example of manufacturing overhead? We had a customer that had a clean room, right? So every part that goes through that clean room, they wanted to add a little more cost, and it's not part of the routing, and it's not part of the, you know, it's stored on the item record. For that item, it was kind of a clean room cost. It might be storage. Maybe you've got to, you know, we work with ice cream company, and they store in a freezer, huge warehouse room that's middle of a 90-degree day. It's, you know, it's seems like it's 10 below in there, but again, you've got what I would call some manufacturing overhead. It might be special equipment. It might be something that isn't really part of any routing. And you have options. You can store it on the item itself. There's two fields, that Jenny's showing. You can do a percentage of the cost, or you can do a direct cost that just, you know, it's so much. And there's a third option too, which, are we going to show the third one or just talk to it, where you can create a routing step?
just talk to it.
Okay, so the other way is on a work center. If we go to a work center, we could show that where you would do that. Let's say you want to, in the routing, represent a manufacturing overhead. So you add a route step, and you have a work center identified. Instead of in hours, it's unit. So there's a time, instead of time, you would put unit, and then in your left side you would put, you know, 50 cents or $1 or something. So if I was running a quantity of 500, it would add, let's say we had $1, and it would add $500 to manufacturing overhead. So you can, there's like two ways you can put it on the item record, if it's consistent, or you can put it in the routing to get that additional, I'll call it the cost in there, and that ends up in manufacturing overhead. So we do have people doing that. It's kind of a hidden feature if it applies to your business.
Okay, and then on that finished good item card, as John mentioned, you have your indirect cost percent here on the cost and posting tab. And then on your replenishment tab, under the production section, there is the overhead rate. So you can see that's where we put ours. We put overhead rate of 50 cents in.
And that ends up in that statistic window again in the manufacturing overhead.
Right. Right now, you'll see the actual cost is 0. This is because we didn't post output yet. That displays once we post output, which we're going to do next. So we'll show you that. All right. So finally, we have output. We are going to output our finished goods. So again, output can be posted from an output journal or the production journal. When posted, it immediately creates an item ledger entry to add the finished good to inventory. And it posts a general ledger entry at this point in time only if expected cost posting is turned on. So you have to have expected cost posting turned on for it to post expected cost for that output line in your item ledger entry and your GL. The actual cost of an output line is not posted until we finish the production order, which we'll show. And similar to what John mentioned earlier on raw materials, the unit cost it uses to post that expected cost is the unit cost from the item card. If you're running standard, of course, your unit cost is standard, so it'll be the standard cost. But if you're running FIFO, LIFO, or anything other than standard, it's going to use the unit cost, which is an average. It doesn't know the actual cost yet. It has to roll all that up once the production order is complete. So it will use the It'll be the average when it's FIFO and LIFO. And the GL accounts are taken from your finished good inventory posting group. So in this case, it's expected costs, so it'll debit your inventory interim account, and then it will credit WIP. So WIP will then get shored up on that finishing of the production order, that transaction. All right, so let's go into the production order. Let's post our output. Again, I'm going to use the production journal. And we actually have as our final operation step a post output step. So I'll go ahead, and my output quantity is 50. That is what we're outputting. No changes to that. So I can go ahead and just post my journal. All right, so let's first look at order statistics to show you that the manufacturing overhead now posted. So that actual overhead posted on producing an output entry. And now if we look at the item ledger entries, we'll also have an output entry here. So here's our output. You can see we have a cost amount expected. So again, that's going to be based on the unit cost from the item card. I'm in a FIFO environment, so that's technically an average cost. All right, John, anything you want to add here? Actually, there's one thing I do want to add here. I have seen customers in certain environments, especially with custom finished good items, where they create the finished good item, but they do not populate the unit cost. They leave it 0 until they, they start running it through production. The bad thing about leaving that finished good item unit cost at 0 is then when you post output, your cost amount expected, your inventory posts at 0. So really everything is sitting in WIP. And that's fine if you finish your production order in the same accounting period. Where it gets a little dicey is when it's going over one or multiple accounting periods, 2 or more, because then your finished good inventory never gets hit. And if you're running standard costing, your variances never get adjusted in the correct accounting period as well. So just something to keep in mind.
Yeah, I'll add to what Jenny just said is, like we get a question like, when would I mark to expected costs and when not to? And I'm going to say that, our best practice is to mark it, to say, yes, we want to post expected costs. Now, why would you not want to post expected costs? It might be if your production runs are very short, like, a couple hours or less. You could, by the time you start the order and you finish it, it's all in the same day. You might get away with, well, we don't really need to post expected costs because our window is really short. But as Jenny was describing, if you have, and this is the case in a lot of companies, at month end, you have hundreds of production orders that are in process. And if you haven't posted expected costs, now you got to figure all that out. That's why we usually recommend on almost all situations to post expected costs for manufacturers, unless you have, like I mentioned, a process where we pretty much start and end at the same day. You might get away without having that flagged.
And on that finished good item, if the unit cost is 0, again, if this doesn't get completed within the same accounting period, you can always sell that finished good inventory in this accounting period. So then what happens is you sell it, and then you have your sale in this accounting period. and it posts the cost of goods for that sale as 0 because the item card was 0 and this has not been finished yet. So then what happens is if you're in your next period and you decide to finish that production order, it'll go ahead and adjust that sale from the prior period, but your costs will be in the wrong month. You know, if you've closed out that prior month, now you have the sale in one month and the cost in the next. So it's just something to keep in mind, something that's important to look at.
Yeah, and I'll add to that too. I think the longer your production order is on the floor, the better, you know, a good discussion is, okay, let's talk about month end. Because, you know, if I've got a production order that's on the floor for 2 weeks, you know, I have seen customers that will finish the production order at month end and then open a new one, and that you don't need to do. We just have to walk through so you're aware of what's the best practice, I guess, because we've had a chance to see all kinds of different setups, and hopefully we could help with that discussion.
All right, so let's look at the output transaction. I'm just going to look at the value entries for that to get to my GL entries. All right, so you can see here with this output transaction, it posted a credit of $476.39 to WIP and a debit of $476.39 to finished goods inventory. The interim, in my instance, my interim setup is the same account. All right, so now let's just take a final look at item statistics. So we have our actual total cost of $423.58, quite a bit over our expected. And that's what happens when you have demo data. But you can review that actual cost before you then post change your status to finish.
I have seen a question, just one on that statistic screens, for instance, when you're doing a new standard cost for standard costers, it does grab the latest standard. You don't have to refresh your production order to get the new standard whenever you're doing that. It's a little side bit there.
All right, let's look at the final step of finishing a production order. Again, this is done with the change status function on your release production order page. A few of the things it does upon finishing. One, your output item ledger entries. It updates that cost from expected to actual. If your finished good items are standard cost, it'll post all of the variances for the production order. And it will also, once adjust cost item entries is ran, it'll post your GL entry. All of the GL accounts come from your inventory posting group. So you'll see all of these accounts on that inventory posting group setup screen. So depending on the cost, it'll either debit or credit any of these accounts. So your WIP, you have material variance, capacity variance, capacity overhead variance, subcontracting variance, and of course your manufacturing overhead variance. So again, the variance counts only used if you're using standard costing. All right, so let's go ahead and change our release production order to finished. And we can go look at that finished production order. And we can look at the order statistics. All right, so our actual was $423.58. And now if we go look at our item ledger entries, if we look at that output transaction, you'll see there's no longer a cost amount expected. That was reversed. And the cost amount actual of the $423.58 was then posted. And if I look at that value entries, just to get to my GL entries, all right, you can see the 476.39 reversed, the 476.39 debited to 10,700. Anything else to add on finishing a production order, John?
No, just to reaffirm, once you finish it, you can't make corrections. So it's important that who's ever finishing them does that, what I call just review that, statistics. That's a great tool just to, oh yeah, it looks reasonable, and then finish it.
All right, we've gotten through all of the cost components to a production order, how output and manufacturing overhead work, and how to finish a production order, and how all that affects the general ledger. So is there any questions at all?
Thanks, John and Jenny. No questions have come through. If anybody does have any, now's your opportunity.
I have a question for the group. We'll end our part. Yes, there's FIFO, LIFO, average, specific, and standard. They're missing one of the costing methods, right? LAFO, anybody hear that called LAFO? And I always say that there's only like 2 or 3 accounting jokes, and this is a LAFO, is let the auditors find out. So ending on that, yes, on a Tuesday. And Jenny's never heard that one before.
Yeah, I really wish everyone could see my face right now. I'm shaking my head. I've heard that for like 10 years.
Hey, Tom Blaisdell liked that at Microsoft, so he actually used it. So.
Okay, sorry, Angie.
No, you guys just got a lot of laughter, that's all.
It's silent laugh.
Yeah, silent laughter.
Or groans.
All right. Well, if nobody has any further questions, we just want to thank you all for taking the time out today and being with John and Jenny to cover on this topic. If you come up with any questions later, feel free to contact your account manager, or Jenny has her information up on the screen, and you can give a shout out to her with any questions that you have. So thank you, John and Jenny, for presenting. It was very well informative.
No problem.
All right, everyone. If you haven't seen our website yet, we have started some more training workshops for you and your team members to attend. So visit our training workshop page, and that's inovia.com/workshops for more information and to register for the training workshop that fits your role. And we do have more webinars coming up. This afternoon, we have Expand IT presenting on top 5 ways service management companies lose money and how to fix it. And on Thursday this week, we have our very own Amanda Ejiro presenting on speed up your revenue and expenses process with deferral templates. So check out our website for more of our upcoming events, and that's inovia.com/events. And we also have a podcast going on, if you haven't heard of it already. It's called the Inovia Conversation, and we just want to encourage you to listen to the selection that our hosts, Steve Waltz and Jeff Pergolski, have provided to us. And you can find out all about the different podcast platforms to listen to on our podcast page, and that's inovia.com/podcast. So check out the selection and subscribe so you'll be notified when those new episodes air. All right, well, we thank you again, everyone, for joining us, and we look forward to seeing you soon on another Inovia webinar. Take care, everyone.